Indicators. Almost every trader uses them. They are tools designed to help you trade by giving you more information. There's a million different kinds, and they can show you potential inflection points, whether the market is overbought or sold, and even give you detailed entries. Oh, and they're also ruining your trading. Here's the basics. Indicators are mathematical tools that plot information on the chart to presumably help traders. Some of the most common are RSI, MACD, Bollinger Bands, Fibonacci, and the list goes on, and on, and on. In fact, it seems like if you throw a stone anywhere in the day trading space, you'll find somebody pushing yet another special indicator or indicator setting. There's literally an infinite amount of variations of these that you can use, and so wading through these as a beginner is incredibly daunting. It also means that there's always something new to chase when that beginner isn't finding success. You didn't have luck trading with a 50 EMA? That's because 50 EMAs are useless. You got to use the 75 EMA. You've been failing using Bollinger Bands? That's because you need to be using MACD. If this sounds at all familiar to you, welcome to the club. We're going to get you out of this death spiral, and in the process help you speed up your trading journey significantly. To do that, let's introduce a paradox. Indicators show you too much, and yet nothing new. In medicine, there's a well-known phenomenon called overdiagnosing. It's one of the reasons why doctors and hospitals have to be very careful to only order scans or tests when absolutely necessary. Because when these tests or scans are done, it can easily lead to unnecessary procedures and incorrect diagnoses. The increase of data can actually cause harm when the fundamentals of patient diagnosis, medical history, symptoms, and so on, aren't the main focus. For example, a patient presenting with chest pain might undergo multiple imaging scans to detect potential issues like heart disease or lung conditions. If the doctors rely too heavily on imaging findings without considering the patient's complete clinical picture, they can overlook other factors and even completely misdiagnose due to abnormalities in the scan. And as scans and tests are getting more sophisticated and able to find smaller and smaller defects or abnormalities, these issues are getting bigger. The more complexity and detail, the greater the focus needed on the fundamentals. The scans and tests should be typically used as a confirmation of what was found during a study of the patient fundamentals. You may get where we're going with this, but most day traders have a very similar issue. More and more sophisticated indicators based off of various mathematical tools crop up every day. These may be okay in themselves, but are simply a way to confirm what the fundamentals, aka the price action, are saying. They are not a trading strategy. In fact, more data is usually bad for a trader, as it can cause bad entries or simply analysis paralysis. This problem is even worse than that in medicine because medical tests can actually show something that couldn't be found from the patient's symptoms. Indicators can't. Period. All an indicator is another way of looking at what is already there on the chart. What indicators end up being, then, is a very compelling distraction from the thing that is actually going to make a trader profitable: price action. Because indicators are very concrete, they're very tempting to put trust in, rather than spending time becoming familiar with very unpredictable price action. But that's not all. There's even a bigger reason why they're so dangerous, and it's in the form of another paradox. Indicators do make you better, until they don't. Let's put a monkey, let's name him Jeffrey, in front of a monitor with our favorite brokerage and charting system installed on it. We're going to allow Jeffrey to randomly press buttons and take trades, and we're going to compete with him for 6 months to see who's the better trader. Now, if you're a newer trader, you'll come to the shocking conclusion at the end of this competition that Jeffrey is simply better than you. Yes, that's right. Jeffrey the monkey has lost less money than you have. Embarrassing, right? But let's dig into the reasons why. See, Jeffrey hasn't made money. He's simply broke even. That's because he's a monkey and an idiot. His trades are completely random. So at the end of his trading, due to the random nature of the market and not counting commissions, he would average out at break even. You would not. See, as any beginning trader can attest, you are not random as a beginner. Unfortunately, you are non-random in the wrong direction. You will take more losing trades than you should statistically. In fact, there are dishonest, unregulated prop firms that will take the opposite trades that beginners will, simply because beginning traders are insanely good at making the wrong prediction. There are a lot of really interesting reasons for why that is, but suffice it to say, the way an untrained human brain works is actually at odds to the way price action behaves. So as a new trader, you'll lose money and the 10 bananas you bet Jeffrey. Here's where indicators come in and why they're so dangerous. New traders losing consistently are looking for a way to stop the bleeding and for concrete reasons for the losses. This is when they add indicators into their trading and completely systematize their strategy. A plus B equals take trade. Price crosses the 50 EMA, the RSI is 30, and a bearish candle signals a reversal, take trade. Intuition and judgment are completely discarded. Now, as we've discussed in our previous episode on strategy, if there was a simple plug-and-play system like this that was consistently profitable, we'd all be millionaires. There isn't. All systems like this do is completely randomize your trading, basing all of your trades on a random concoction of triggers. Congrats, you're now Jeffrey. The problem is that you were losing money before and now you're not. You're break even. You've made progress, you think. But instead, you've now taken a massive step backwards. You've taken your brain completely out of your trading and made it almost impossible to let go of these indicators because that would mean going back to losing. Like many beginners, you're now stuck in a never-ending loop, never allowing yourself to get worse, but unable to ever become profitable. Before we end, let's touch briefly on another more sinister category of indicators, paid indicators. These are indicators, some more or less sophisticated than others, that give exact buy or sell signals for a price. They're sold by enterprising thieves online, promising that if you just buy this indicator and do what it says, you'll become rich. These are, to put it mildly, complete garbage. If you had a money printing machine, you wouldn't sell it for $20, and neither would your favorite guru. Turns out, it's much easier to make money off of naive, hopeful people who don't know any better than to actually earn at trading. Backtesting data is not a proof of the validity of the indicator either. It's incredibly easy to reverse engineer an indicator by tweaking a few constants until the backtesting data is incredible. It's simply overfit and useless as a future predictor of price. There are quite literally indicators based off of astrology that have amazing backtesting results for just this reason. Ultimately, as the old saying goes, price action is king. It's what all of the indicators are based off of. So why not get rid of the indicators and go straight to the source? While it's tempting to look for something concrete that will give you specific entry points and remove the gray areas of trading, those gray areas are what you need to train your brain to recognize. Because over enough time, without the distractions, it eventually will. The most complex computer in the universe is you. When you eventually become profitable, it's going to be because you spent the hours and years training it to recognize things that the MACD could only dream of. Thanks for listening, and if you found this useful, please consider leaving a review and sharing this episode with a friend.